So as I was saying, um, this stock is too small of a return, and what I mean by that is, um, usually there's 3 months in the for the quarter, and so basically when a quarter gets reported, obviously you want the stock to go up, and you expect the share price to go up. You want earnings to beat, and you want to make money. I think that's the main goal for everybody. So what I'm trying to say is when the earnings get reported, right, and whatever, whether it goes up or down or not, um, what I'm trying to get at is over time you want the share price to go up. So I think a majority of us, um, even when the share price goes up, whether you want to leave or not, you know, you you want it to be a good amount. So what I mean by that is, when I say it's a small of a return, um, even though the share price is really low, like let's say $10, right? 3 months later, the expectations of it, you wouldn't want the stock to be like, after 3 months, you don't want it to be like $1.50 3 months from now. I mean, you would expect it to be way higher than that. And, you want to exceed those expectations. So, I mean, you're talking about, okay, $1.50 in like 3 months. So throughout the whole year, we're talking about $6. So basically, if you only gain $6 in the year, that's exactly what I'm talking about. I'm just giving an example. So let's say even if the stock is like $10 in the beginning of the year, I'm just giving an example, and then at the end of the year, $6. I mean, eh, at least it gained, but it's just not a sufficient gain for me. I just it just needs a higher return. I mean, some people might be satisfied with that, but it's just I don't know. I guess I'm really strict on my goals, and I just want to exceed those expectations. So basically, the expectations, I want it to be more than what it is. Um, so yeah, the debt needs some work, and the positive things on this stock, KTOS, for the positive, that's actually a positive sign. So I wrote consistent earnings beat and very cheap price. So that's exactly what I was saying. Um, when I say consistent, I don't mean like all the time, but I mean the majority of the time. So let's say if they beat 3 out of 4 quarters, then I'd say that's pretty consistent. Um, if it was half, like let's say they beat 2 out of 4, and if, for me it's doable, but it depends how much they beat it by. So what I mean by that is, let's say okay, let's say Wall Street put a expectation of $1, and if they only beat it by a few cents, then they beat let's say the first quarter, second quarter, and third quarter, they only beat those quarters by a few cents, and the last quarter they met, then it's doable. But then if there was a surprise earnings, the surprise earnings means like they beat it by a lot, not by cents. They beat it by like, you know, I don't even know how to describe it, but like um they exceeded expectations. It'll be like over 50 cents or something like that. I don't know what's the going rate for it to be a surprise earnings, but I mean they beat it by a lot. So I definitely take that into consideration, and I really like to challenge myself in finding these really really good companies. I know they're hard to find, but there are a few companies that actually do have the surprise earnings beat, and I'm just using this as a guide for myself, and maybe for you guys to get something out of it and enjoy this. Um, so okay, the next one, ISSC. I put they have low volume, and low shares online. And they do miss earnings. That's the negative part of that. And the positive part of that is it says they're number one for debt, um, 6.60, and they have strong cash flow. They have a lot of cash flow. Number one for debt. It's not like to be more detailed about that. They're number one for having the lowest debt. I don't mean like the highest debt, because right away, oh, they're number one for debt. I don't mean like the highest debt. I mean the lowest debt. So they're number one for that. And again, their debt rating, well, the debt percentage is 6.60%. That is just like phenomenal. Um, but again, they did not make the watch list just because of this. Again, maybe in the next year, because this year's gonna be like horrible. And again, possibly in the next year, maybe they can make it to the watch list. I'm not too harsh on companies in any given year. Again, I like to review companies every year, so things change, people change, and companies change. So the next one, VTSI. Again, I wrote no profit, so this company is not profitable. So the next one, uh, another growth company. When I put these little symbols there, growth, and I'll say it too. Hopefully, I didn't miss any of these, but basically these are small cap companies. They have under 10 billion market cap or less. So again, the next company, HII. Then I have the company, the share is really expensive. They're selling at $209 per share at this very moment. Um, the other negative aspect of this, they have high debt. And the third negative aspect I wrote about this, they have negative 34 million in cash. That took some time to actually get the numbers out, but that's the accurate number as of today. Negative 34 million in cash. Um, I can't remember if this was the 2018 revision or the 2019. So again, it's still a recent update, but I just can't remember which date it is. Whether it was either this year or the 2018 one. So yeah, uh, positive. Number two in earnings, they have dividend growth. So they do pretty good in earnings, and they do have dividend growth. So that's definitely a plus. I add this to the watch list. So I'll keep my eye on that one. So the next one, NOC. This one's a really good company. I added this one to the portfolio. Hopefully, the share price goes down, and this one I would consider adding to the portfolio. This is again, this is just for a reference for me. I'm not asking you to do this, but I'm just stating what I analyze and what I'm evaluating. So, uh, NOC. Dividend yield is really low. What I didn't like about it, the debt is pretty high, 78%. And again, I wrote expensive in like capitals. Yeah, they're very expensive. I think the share price is like over $300. Pretty pricey. But what I do like about it, dividend growth. The PE is really, really good. I put superb. Consistent surprise earnings. These guys are always beating earnings by a lot. And approximately half a billion in cash flow, so they can definitely cover the dividends for what they have. So next one, UAVS. They have no profit. This is like a new car with high mileage. When they first came out their first year, the share price went over like $2,000. I think maybe it lasted maybe a year at least. And then after the year, I forgot, it was in the early 2000s, I believe. And after that, it's never hit over $10, even after the second year. So yeah, I don't even know how to describe it, but it's like saying a new car with high mileage throughout the years, ever since it just came out. So yeah, the company was really good just the first year, and after that, it just kind of sold off, and it never um, hit back on share price. Next up, ESLT. They have a low yield, which I do not like. It's a 1.29%. The debt needs work, and the share volume is too low. They are a consistent dividend payer, and they do have room to grow. Um, I'm not ready to add this one to my watch list yet, but I'm not gonna rule it out. Again, negative expectations for this year, and hopefully next year things change for the better. Um, Next up, AJRD. The debt needs work, but the cash flow is strong. What I don't get about this is that I was thinking if they could use their cash flow to pay off some debt. This is definitely a company that I added to the watch list, and we'll see. Hopefully, they do come up with something like that where they use their cash flow to pay some debt. Hopefully, they're smart enough to do that. And if not, I think I don't know. I might take it off the watch list or leave it on the watch list for a while. I don't know, but hopefully they make some good moves and they get their things together and they do the right thing. So this is my review on 11 out of the 42. So this is part one, and I have three more parts to go. Thanks for